Hi, I'm James Robinson, and this is my stock pick of the week. This week, we're continuing our five-part series on Ruger, actually Storm Ruger, symbol RGR. Today, we're going to talk about the balance sheet for Ruger. And if you remember when I talked about the operations for the company, I said they were average at best, and they were not a compelling reason to buy the company. I also said that there was more to it than just the operations, and we had to look at the company as a whole. Well, when you look at Ruger from the standpoint of the balance sheet, what you see is an exceptional company that's got a fantastic balance sheet, and it has virtually no risk of this company not being in business in the short, medium, and long term. Interest rates won't affect this company because it has no debt. They have tons of cash on hand, and they're amassing more cash. Sooner or later, that cash is going to come back to us, the shareholders. So without further ado, let's talk about the balance sheet of Ruger. I think the right place to start looking at a company's balance sheet is to look at their cash and marketable securities. I do that because if a company has enough cash, they can solve almost all of their problems, or they can persevere long enough to figure out a solution to their problems. And if a company doesn't have enough cash, then they only have enough room for one hiccup. And when that hiccup happens, they can put them out of business. So when you look at this company, you'll see that back in 2015, the company had virtually no cash on hand. However, since that year, it's raised its cash reserves dramatically to about $165 million in cash. So this company has about 2 years' earnings in cash and marketable securities right now, which is fantastic. So I want to go over why it's fantastic. There's a number of reasons that this is really, really good for us, the shareholder. The first thing is that they have the reserves to do an acquisition if they want to. They have the reserves to invest in new technologies, to invest in new plants, to buy new real estate, should they need it for their manufacturing. They have the reserves to deal with things like a global national pandemic, should it occur. They also, if they think they have too much cash, have the ability to pay that money back to us in the form of buying back shares or paying dividends to the shareholders. So lots and lots of good reasons for a company to have cash. I like for companies to have cash. At some point, they have too much, and I would argue this company is perhaps at the point now where it has too much cash and ought to be thinking about how to give it back to us. But I'm not going to complain when a company has lots of cash on hand. The next thing that I like to look at is current assets and current liabilities. So a current asset is an asset that they either have or will have in the next 12 months, or that they can liquidate in the next 12 months, I should say. So if they have some real estate, probably they can't sell that. I wouldn't plan on selling that. So that's a long-term asset. But a current asset is an asset that they will have access to within the next 12 months. An example of that is receivables, for example. Current liabilities is money that they owe somebody in the next 12 months. So if they have more liabilities than they have current assets, that company theoretically could have a cash squeeze in the not too distant future. This company is the opposite. It has over $225 million in current assets and about $75 million in liabilities. So it's about 300% that it needs. Again, one might offer that it has more in current assets than it needs, and it ought to be looking for ways to give that back to us, the shareholders. But at the very least, you see this company's always been very conservatively financed. They always seem to have more than enough money on hand to pay their current liabilities. And that's a reason to believe this company's in a strong position. Another way to look at the same slide we just talked about is current ratio. Current ratio is simply the ratio of current assets to current liabilities. And, you see here that the top 25% of companies have a current ratio of about 3. And at about 4, you're in the top 10% of companies. Since 2013, this company has increased its current ratio every year. And they're now closing in on the top 10% of companies in terms of current ratio. And again, that says two things. It says that the company's in fantastic shape, but it again points out that this company ought to be in a position to be giving more money back to the shareholders. And oftentimes you can see that with increased share repurchases, or you'll see it with special one-time dividends, both of which are beneficial to us, the shareholders. This next slide, it's hard to tell, but it looks at the total current liabilities and looks at them relative to total long-term debt. At some point, I like to see liabilities converted to long-term debt, and you borrow some money to pay off all those liabilities, typically because you get better interest rates on long-term than you do on short-term debt. On this company, what you see is that its long-term debt, which in red, has basically been zero for the continuum. It's at about $2 million now, which is a nothing in a $1 billion company. But the other thing to look at here, which is very interesting, is total current liabilities since 2014 have basically gone down every year. A couple of spikes here, but basically it's gone down dramatically from about 90 million down to about $60 million. They've cut their total current liabilities by a third, and they have done it without really taking on any real debt. So that shows me that the management of this company is doing a very good job of controlling costs and is the long-term interest of the shareholders in mind. So interest expense is one of those things where it makes sense to really look at a chart, not just to glance at it. You can see here that it looks like since 2008, the interest expense of this company's gone up kind of every year, kind of dramatically. But that's really sort of irrelevant because it's less than $1 million in interest expense. They only have $2 million in debt after all. So this might be something as simple as credit card interest for the travel accounts that their people use. I mean, it's a zero amount of money. It is a chart, and it does, and I do want to show you this data, but if you look on the left side, you see it never reaches $1 million. It stays at zero. So the interest expense for this company is absolutely insignificant. It's nothing to worry about. It does show that it's growing up, but come on, it's not something to worry about. The other slide, interest income and interest expense. You see the interest income far outstrips interest expense. $2.5 million of interest income last year, and virtually no interest expense. Less than $500,000 of interest expense. So we're making about 5 times more on the money that on our financing for the money we have than we are for the money we borrow. So again, when you have no debt, these charts can be a little misleading when you see the interest expense up a little bit, but nothing to worry about here. Here we're talking about the company's interest coverage ratio, and I should define what that is. Interest coverage ratio is simply the ratio of the company's earnings over a period of time divided by their interest payments at any given time. And so you like to have the earnings be significantly higher than the interest, so that you can easily make your interest payments. And in this case, I like to see an interest coverage ratio of at least 1.5, 1.5. And you can see here that the interest coverage ratio of this company is over 200. So it's fantastically high. It's far, far greater than it needs to be. And again, that's a reflection more of anything that the company just doesn't have any debt. Therefore, it's a very, very tiny little amount of money. It's interesting in this case, the company's interest income alone generates enough money to give us a more than safe version for the more than a safe buffer for the interest expense. So again, the balance sheet of this company is just absolutely rock solid. Years income to pay off long-term debt. Normally you'd see this would be measured in years. 2 years income to pay off your debt is not a problem for me. 4 years is not even the end of the world. For this company, it's about 2 weeks. This company makes enough money in 2 weeks to pay off all of their long-term debt. Again, I do these slides because oftentimes there are companies that have real problems in these categories, and we want to look at them and consider them. But when you find a company whose balance sheet is as strong as this one, I'm really only doing this to point out how strong this is, and I'm doing it because it's a juxtaposition for the company's operations, which were sort of average. One thing to keep in mind, if a company's operations are average, it should be hard for them to achieve this kind of balance sheet. And the fact that they have this kind of balance sheet means that the management's doing a very, very good job with what they have to work with, especially in the industry that they're in. The other thing that is important here to note is that Ruger is competing against a number of other firearms manufacturers. And if those manufacturers have a lot of debt, for example, then when things get rough, they'll be at a competitive disadvantage to Ruger. And they'll have to do things that Ruger won't have to do. And it might even be giving Ruger an opportunity to buy one of these companies should things get bad for one of them. So having a strong balance sheet helps you in the bad times more than it helps you in the good times. But it is also a measure of management and a measure that in the future, things are likely to go better for you than it is for your competitors who may be laden up with debt. I know I'm starting to sound like a broken record. This looks at interest expense as a percentage of operating expense. Again, what we don't want to see is that the interest payments are gobbling up all the profits and there's nothing left for the company, either for the shareholders or for the company in emergency or anything. And again, the interest expense here is so low that it's really not even worth talking about. Again, having no debt is a beautiful thing for us, the shareholders. So that does it for the balance sheet. This company has virtually no debt. It has current liabilities that are in line with their current assets. They have a tremendous amount of money in the bank. They could pay off all of their debt in a few weeks. Interest payments are not a problem for the company. Really, there's nothing else to say here other than the balance sheet for this company, is a 9.9 out of 10.